counting down the days to RebelCon, and virtual passes are now available at an early bird discount of $200 off the normal ticket price. This virtual pass gets you live access to all general sessions with our expert keynote speakers, as well as links to view the sessions later. This deal will end soon, so get your RebelCon virtual passes now. Hit the QR code for more info or visit rebelcon.marketrebellion.com.
And welcome back once again, Market Rebels. Happy Thursday, everyone. Another interesting day in the market. Started off down a little bit. We had jobless claims that came in better than expected, 250,000 versus 260,000 estimate. And as I was checking the last few minutes, it looks like the SPY is going to be up maybe about a 0.5% or so kind of rallied back. But we do have an important resistance level off the 200-day moving average at about 431. So that's a point you'll want to keep in mind. For today, we're going to continue with synthetics. So if you joined us on Monday, I said this is going to be synthetics week, and it actually looks like we will roll into next week after reviewing all of the topics that I want to cover. But it's a really important topic for options traders. Now on Monday, I showed more of the kind of the philosophy behind it, maybe you could call it, the derivation of the formula, kind of the insights into what makes it tick. So if you didn't see that, you want to go back and revisit that. Today, what we're going to do is to what we might call synthetics part 2, is to look at the formula that we kind of came up with in Monday's class, which was the, why is that not coming out there? There we go, which is put-call parity. So put-call parity is this formula in options pricing. It's really the foundation for the Black-Scholes pricing model. And that's what we looked at on Monday, was to show, again, the philosophy behind where this formula comes from. But today we're going to do a little deeper dive and show you how to actually use the formula to come up with your synthetic positions. Now, word of caution, there's a tiny bit of math in here. Don't let it scare you, because if it's a little confusing, tomorrow on Friday, I'm going to show you a super simple method that will allow you to look at a risk graph and you will instantly be able to tell the synthetic equivalent. But we have to go through these steps first. So as a quick review of synthetics from Monday, remember that this magical 3-piece puzzle, what we call a conversion, consists of long stock, long put, and a short call. And if we have those, it creates a guaranteed position. So you can think of it as a bond or a T-bill, bank CD, something like that. And that's really what makes this whole thing tick. The 3 of these pieces completely negate all of the risk, which is kind of weird. If you talk to the average person off the street, they'll say, oh, options are super risky. Not true. Here's a spot where they actually completely eliminate risk. So the better way to understand options is that they are a tool for adjusting risk. Yes, a lot of traders adjust their risk levels up, but we can easily shut it off as well. So it's these 3 pieces right here of a conversion that allow us to create the put-call parity formula. So here it is, stock plus put minus a call is a bond. Now again, if you did not see Monday's class, you'll want to go back and check that out, because I showed why this works. The kind of the fundamentals or the logic behind what's making this work. So in symbols, in the real world of trading, we don't really consider the bond. There's a reason for that. We'll talk about it in a future trading tune-up, but this gets to the difference between what's called a mimicking portfolio versus a replicating portfolio. And whenever we talk about synthetics, we are talking about a mimicking portfolio. So we're just going to ignore the bond. So the whole idea is that we could write it more simply like this: stock plus put minus a call, that means a short call, that minus C, equals 0. That's a little shorthand notation for saying there's no risk. So one of the things to see is that any one of these three pieces can be created from the other two. It's going to take two pieces to create a synthetic. That's what's the synthetic equivalent. Now, another thing that's important about synthetics is that the thing that you're trying to replicate will never appear in the answer. So for example, if you're trying to figure out what a synthetic call is, the answer shouldn't be, well, that's going to be a call plus something, or no, it's not. The call is not going to be in the picture, long or short. That's what you're trying to replicate. So it would be a combination of the stock and put. So let's try that. Let's do that one. What is a synthetic call? Well, if you want to get to really the more formal way of figuring it out, it would be from this formula. So we have stock plus put minus call equals 0. And we're trying to figure out what is a long call. Notice that in our formula, we have a minus call. That's not what we're trying to figure out. We're trying to make it long. How do we do that? This is where the little bit of math comes in. So for those of you who remember the basic algebra, what we're really doing is we are adding C to both sides. So if I add a C to both sides, I keep the equation in balance. So notice if I add a C to the left side, these cancel out, and I would have a positive C on the right. So a simpler way to visualize it is to just think about putting your finger right there on that minus C, swinging it over to the other side. And if you do that, you always change the sign. So because we have minus C right now on the left, if I swing it over that way, it becomes a positive C. And so there's your answer. Positive C, a long call on the right, equals stock plus put. So that is telling you that stock plus put equals a call. That means if you buy shares of stock and buy a put, your risk profile looks exactly like that of a person who buys the call. Again, this is assuming we have the same strikes. Okay, we talked about that in Monday's class. Now, what makes them synthetically equivalent is this. Their risk graphs look the same. So here's our long call on the left. Here's our stock plus put on the right, and look at that. Can't tell them apart. That's what makes them synthetics. We talked about that on Mondays as well. Even the word synthetic, if you think of synthetic oil or synthetic wool, they look, act, feel, behave just like the real thing, but they're made from other pieces. And that's what's going on here. Stock plus put is built from other assets, but it looks, acts, feels, behaves in every way just like the call option. So here's what's going to happen if you want to see the details on that. Let's say that we have two traders. We've got one guy who's got $10,500 in cash, and he buys the $100 call for $5 or $500. We're going to compare that to another person who has 100 shares, but buys the $100 put for $5. All right, now these should be equivalent, so watch this. If the stock goes up at expiration, what's going to happen? The person who buys the call can exercise the long call, and he's going to be long shares of stock. Where does he get the cash? He's already got the cash. So he's going to be long stock at expiration. If the stock goes down and is below 100, the call expires worthless, and he's got his $10,000 in cash. What about for the person down here with 100 shares and the put? Stock goes up, the put expires worthless, and the person is left with their long shares of stock. Stock goes down, what happens? Put's in the money, he can exercise the put, receives the $100 strike, that's $10,000 in cash. And take a look at both traders. If the stock goes up, both of them are long shares of stock. And if the stock goes down, they're both long 10,000 shares of stock, or 10,000 cash. Doesn't matter what happens. They are in exactly the same positions. And so that's really what it means when we say that they are synthetic equivalents of each other. So that's going to be super important in future trading tune-up classes, Q&As, coaching calls, everything that you might be doing, because this is really the essence of a strategy. If you're trying to figure out what makes a strategy tick, it's this equation right here. So that's why we teach it. So right now it might not be super clear, but it's important that you understand the steps. All right, let's try another one. What is a synthetic short put, or sometimes called a naked put? How do you figure it out? Go back to your basic equation, stock plus put minus call equals 0. What do we have to do? We're trying to figure out a short put or a minus put. I don't have a minus put in here. I've got a plus put. How could I get it minus? Well, I could simply subtract a put from both sides, or more simply, swing the put over to the other side. So if I do that, we end up with a minus put on the right, which is exactly what we're trying to solve for. What are we left with? Long stock minus call. So this formula tells us that shares of stock plus a short call is exactly the same thing as a short put. Now, many of you recognize stock and a short call as a covered call. And this is another important insight with put call parity. It can help you with trading decisions. Most brokers will allow a covered call with a level 0 option approval level, but they're going to require the maximum, whether it's a 3 or a 5, depending on the scales they use, to do a short put. And yet they're exactly the same. So this can also help you with your trading decisions. If you think that you're deciding on doing a covered call here, ask yourself if you would short a put. And if you say there's no way in the world I would sell a put here at this level, then you shouldn't be doing the covered call. It's exactly the same thing. And put call parity shows that. Look at the short put on the left, stock minus call on the right. They are exactly equal. So those are the things I would like everybody to work with. It's going to just be a little bit of work, but it will go a long way. So there are 6 basic synthetic positions. We have the call, which of course is stock plus put. We have long stock, which is call minus put. And we have a long put, which is short stock and long call. But we can also look at the opposites of those, which are just the counterparts. Should just be putting a minus in front of those. So notice that if the green C, a long call, is stock plus put, a minus C is minus stock minus put. So in a way, once you can figure out the first 3, the second 3 are layups. They're just flip the signs. But once you do this a few times on paper, you'll be able to do them very, very quickly in your head. Now, what else can we use put call parity for? Well, there are so many uses. Now, here's one that I get asked a lot whenever we're talking about pricing models. And people say, well, what interest rate are they using in the market to price this option? Very good question. How can we figure it out? Well, we know that call minus put has to equal the difference between the stock and the exercise price. This is right from put call parity. So let's say that we have a call trading for 438 and a put trading for 2, and the stock is 50 and the exercise is 50. Well, take a look at this. 238 doesn't equal 0. Where's this additional 238 coming from? It's coming from the cost of carry. And from that, we can figure out the interest rate. So this is another little handy tool if you're just trying to figure out different aspects about option pricing. Now, just for a little side note, I know some people might think you're going to take 238 divided by 50. You wouldn't. You would have to take, it's a little technical, but you have to look at the present value of this. You'd have to take 238 divided by 50 minus 238, which would be what, 47.62? And that's going to come up to be 5% interest, which is exactly the interest rate that I used to generate that call and put price. So it all works out. Lots of different ways we can use this formula. Here's another one. What about early exercise? Is it beneficial to exercise a call option early? Go back, we got call on the left. That is equivalent to stock plus put minus the exercise price. Now, in this case, I am putting the exercise price back into the equation. And what happens if we exercise a call, all you're doing is throwing away the put. You're also paying for the stock early. But the big insight is that you are throwing away the put. This is why whenever we teach classes on should you exercise early, and there are a few cases where it might be beneficial, when the stock pays a dividend, we're going to see if the dividend is greater than the value of the insurance. And this is why. So under most cases, if the stock isn't about to pay a dividend, it is not in your best interest to exercise it early. You can always exercise at expiration and pay the strike, but keep the insurance in place as long as possible. So there's your long call before the exercise. If you exercise, you're switching from the blue to the red. What did you do? All you did was you raised your downside hedge for nothing, just threw it away. So that's why we don't, in most cases, exercise a call option early. But what I wanted to show here are just a handful of ways that will make you better traders, give you better ways to make decisions if you understand put-call parity. Now, once again, if this seemed a little confusing or if you're a little rusty on the algebra, there's a much easier way to visualize. And so tomorrow, I'm going to show you how to look at any of these risk graphs that we've visited here, and you will instantly be able to tell what the synthetic counterpart must be. But we'll have to save that for tomorrow. I look forward to seeing you then. And in the meantime, if you'd like to join us, some of our world-class coaches, for a free consultation, 30-minute one-on-one, phone number there is 815-957-9125, and no cost obligation. You certainly can't beat it. But they'll have a chat with you about your trading styles, your goals, what are you trying to do, and give you lots of really helpful tips and insights like we do 3 days a week here on Trading Tune-Up. So I hope that helps for now. Please join us tomorrow, 4 p.m. Eastern, and we'll also see you hopefully on Cocktail Hour at 5 p.m. And then I want to wish everybody a very good weekend if I don't see you then. But I'll look for you tomorrow. Thanks so much, everyone.